Joining me to discuss the VC climate right now and whether VCs are basking in the glow of the LinkedIn IPO or a little freaked out by it is Jeffrey Yang. Jeff is a founding partner of Redpoint Ventures. He's joining us from Bloomberg's San Francisco bureau. Thank you so much, Jeff, for spending a little time with us. We appreciate it.
Thanks for having me.
So, I have to ask about LinkedIn to kind of kick it off here. As somebody who watches the tech industry very closely, what do you think is going on here? Are we indeed seeing a bubble?
It's hard to say. I think the fundamentals are really very strong, and I think part of the reason why the LinkedIn offering was so strong is that social is really the next phase of the development of the internet. And people is really the platform, and it really changes the nature of the internet dramatically, both in terms of the connective tissue of the internet as well as the applications and services that runs on top of it. And right now, LinkedIn is really the only way that the public can play the what is arguably the biggest change in the internet.
But is it the best way to play it? If you look at LinkedIn versus something like a Facebook or even like a Twitter, which are valued as are valued at larger companies before we saw the big gain in LinkedIn shares, at least. Is LinkedIn the best way to do it? The business model is a bit different than some of those others.
Yeah, absolutely. But if you take a step back for a second and you look at the core social platforms, there's really LinkedIn, and then behind it is Facebook, and then Twitter, right? And those are really the kind of the core platforms. There are some emerging ones in locations, maybe Foursquare, and in question response, maybe Formspring. But there really aren't that many platforms out there. And then after you get kind of beyond the platforms of the services and the applications, the ones that really have some real momentum right now in the game space are Zynga and Kabam. In the local space, you've got Groupon and Living Social, and in the commerce side, really Guilt. And then there are the ones that are the up-and-comers that have a lot of traffic. On the content side, you got things like Scribd and Machinima. On the marketplace and classified side, you got things like Oodle. And on the professional services side, you have things like BranchOut. But as a public investor, given all these things that are really changing, there's really only one way, to play it, and that's through LinkedIn. And LinkedIn, if you just look at their numbers, their growth is really spectacular. They're growing at 100%, and in fact, quarter over quarter, and in fact, their growth is accelerating right now. And so I think that's part of the reason why it's attracting so much attention. And part of it is that the individual investor out there really can't participate in the other platforms like Facebook or Twitter right now.
Well, how about somebody like a venture capital investor more on the private side? Does LinkedIn make it that much tougher for you in terms of valuations? Because you're not getting in right at the ground floor of these companies. You're a little bit of a later stage investor. Is it harder for you to find things that are good values?
Well, just as an aside, our core is really the early stage. The majority of what we do is a startup, and we have a growth practice that invests in established companies. But the bread and butter of our business is really the startup. But what you're seeing right now with, what you're seeing in the public debut of LinkedIn, and then, whenever Facebook and Twitter and the others come, is something that we've seen kind of in the private market really for the past 18 to 24 months, where, these companies have been doing private rounds of financing at ever increasing prices. And I would say about a year and a half ago, it was really just a small handful of companies that were really getting premium valuations. And really in the last 6 to 9 months, that's really bubbled down to, all the way down to the bottom of the funnel to at the raw startup. Valuations have gone up substantially because of, the rise in the pricing umbrella of these platform companies. And so it definitely makes our job harder. When you look at something like LinkedIn, or eventually when Facebook comes out, those are companies that have substantial revenues and some substantial profits. And we can argue about what's the right PE ratio to put on something like that. But those are not companies that are going to fundamentally are going to go out of business. They're going to be here for a while, and they're going to be important companies. When you go down to the level that we're operating at, the startup, and you're seeing the rise in valuations that has occurred because of the rise in the pricing umbrella.
Right.
These are companies that could go out of business.
All right. Well, Jeff, we're going to leave it on that note.